Hey, it's Richard with Matthews Wealth Management. Fun day. We've had the weekend of the bank insolvencies, and I've had a number of emails, texts, phone calls, discussions with peers and clients and prospects and everybody under the sun. So I figured I would throw this together. I found a whiteboard. It's been a while, right, since we've had one of these, but want to talk about what's going on and what's happened specifically with Silicon Valley Bank. How perfect is that naming, right? So let's talk a little bit about what has happened, and most importantly, what led up to it, and the mistakes that we're making about what we're going to do about it, and kind of how we've been looking for some sort of an event such as this for a lot of our reallocations that we did back in December, and then also through January, February, while in the midst of meetings. So I'm going to try to keep this quick. I want this to be informative and engaging and all that good stuff. So let's use the whiteboard. First thing we're going to talk about is fractional reserve banking. And it's not specifically just fractional reserve that I'm going to cover, but the fact that the Fed has been very involved and generous with the banking sector for quite a while. They just like to flood the economy with liquidity because it boosts demand. Not production, but just demand. So anyway, what happens is the Fed takes their money, and the Fed, they have the printing press or the digital transactions, and they will send it over to a bank. All right. So let's say that they give this bank, and in our example for what we're going through right now, Silicon Valley Bank, or even just deposits that big tech put into Silicon Valley Bank. Let's say that that's going to be, $100 million. All right. So what does fractional reserve means? It means they only have to keep a fraction in reserve. This is hard stuff, isn't it? So what is that ratio? It changes. It's different. We have different regulations, and sometimes we want more, and sometimes we can deal with less. All depends on stress testing, because that's been working. So let's just say that we can have 10% in reserve, which means that 90% can be created in loans. So that means that we're going to have this turn into $900 million of what Silicon Valley Bank decides to loan out. Now, back in 2008, right, the mortgage crisis, what Dodd-Frank looked to do was solve the problem of putting these investments into bad loans, right? Because people couldn't pay for their mortgages once rates would go up, et cetera, et cetera. So this $900 million created out of thin air, it's not just the Fed that prints money, it's also these banks. Now this out of thin air money, that $900 million. So we've got a total of $1 billion going in. However, we can't just put that in bad loans. We have to also put it into treasuries. So we're going to have 450 that goes into, well, I'll just say it, ESG crap, and then another 450 that goes into U.S. treasuries. What is U.S. Treasury? We're going to talk about it on interest rate risk. But Dodd-Frank is what created this. All right, so that new requirement was supposed to be the safety valve, so we don't get another 2008. All right, every bit of money that comes off of these as far as interest was profit for the bank. So of course, they want to put as much in here as possible and as little in here as far as risk, but they want that interest rate, right? Because that's the profit, that's the bottom line. That's how banks make money on your money. That's why if you put money in a bank, they really appreciate your money because they're making interest on it. Cool? All right, I hope you all already understood that. And because I have not put much work into this, don't correct me correct me if I'm wrong. That's cool, but I may have missed something in there, misstated, because we're trying to get this on one take. All right. Interest rate risk. Let's talk about that. I wanted to do a video on the 101 and all of the educational stuff on the website at one point, but this is a hard concept to explain. So pay close attention just for a little bit of time. I know we don't have much attention span, but from 2010 to 2022, we had 0% interest, right? And so if you had $1,000 you put into a treasury bond, let's say for a 10-year bond, you might make 1%. All right, well, so last year the Fed starts raising interest rates. So what does that mean? Well, you can buy one today at 4.5%. Okay, great, simple. What does that mean? That means that we're going to make, in this case, good gracious, $10. Ugh, but that's why nobody wants bonds when GameStop's going through the roof, right? Or Bitcoin through the roof. But they had to, right? They had to buy those. Yeah, I didn't want to, but it was safe. So let's go to the 4.5%, and instead you get a whopping $45. Hooray! What a rate of return. And that's a per year thing because it's a bond, right? And it's guaranteed by the full faith and credit of our government. All right, well, what's the problem here, guys? Well, when they're owning a bunch of $10 per year yielding bonds and their current $45 per year bonds, all of a sudden that's not worth $1,000 anymore. Okay, like if you've got to sell an old bond at a lower interest rate, you're going to take a haircut because why would somebody buy it? Well, you would buy it if you get the right discount. So what is that discount? Well, times 4.5. Cool. A little bit of algebra here, guys. 1 divided by 4.5 equals 22.2%. What does that mean? That means that your $1,000 bill is now worth $222.22. That is interest rate risk. That's why most of the 60-40 portfolios for retirement last year lost 20 to 25% in long-term bonds, was because we were raising interest rates. So when rates go up in bonds, the price of old bonds goes down. Now pay attention to what happens next, right? As interest rates come down, the price of old bonds goes up. So there's a little bit of a hint on what you should be looking at. Anyway, so this 222.22 creates the problem for Silicon Valley Bank because it's not worth $1,000 anymore. Okay, we're back. This was a cut. We never have to cut and edit like this, but I've got a better mic. I realized I was doing just terrible audio before, and oh my gosh, what a day. Anyway, we're going to talk about mark-to-market. Mark-to-market is an idea that kind of came around back in the Dodd-Frank based on what we saw with the mortgages during the real estate crash. Had we been able to properly put collateralized mortgage obligations with the right default rate and not let them get mixed together, blah, 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 whatever. So mark-to-market today, what that means is basically we're going to price the value of an asset that's on somebody's balance sheet to what the value is in the market currently, okay? So if you buy one of these bonds at $1,000, well, because of the interest rate risk, we're going to price it at $222, right? So hopefully you're seeing where this is going. So of the bad debt, the ESG garbage, the stuff that I say it's bad debt. It is. It's just part of investing. Sometimes they're bad calls, and that's cool. No problem at all. But we've got this, let's say 900 that we've created. So we're going to put 450 here, 450 million. And then based on the Dodd-Frank requirement, we have to have another 450 in our nice, easy, safe, and secure U.S. Treasuries, right? So let's assume on our bad debt that there's a default rate, right? Our default rate in this example, we're going to take out 15%. And get my calculator on my phone. Sorry about that. Normally I memorize this stuff, but that's not a simple one. Anyway, so 450, and we're going to multiply that by 0.85 because algebra. And that gives us 382.5 million is the mark-to-market value on the balance sheet for our hypothetical Silicon Valley Bank. Now, what happens to the treasuries, right? Because it's safe stuff. No, it's not. Pretty simple to see what's happening here. So we're going to have 450 million, and in this example, 22.2% of it, right? And because the last cut, I already did the math. I know what this is, and it's actually super simple to figure out.
All right, cool. So we're going to have a minus 77.8% haircut because of interest rate risk. So what's sitting on the balance sheet here is going to be a nice round $100 million value of the bonds that they purchased all throughout the old years because safety or whatever. So let's add all this together. We got our 900 million and we've got our 482.5 million. You see the problem here? That gap is what's making these banks insolvent, all right? Because they have to make up that gap somehow, right? Based on the capital reserves, but also just the overall capital, right? So that's where they don't have enough assets to cover it. Because remember, we were dealing with 10% fractional reserve requirement in this example here. Oh, how are you going to make that up, right? So they're bankrupt, insolvent at that point. All right, so what are we going to do about it, right? Because the government created this problem. I want to be completely clear about that. This is a legislative disaster, right? This is completely preventable. This is short-sightedness. I know there's some older annuities out there where they have an automatic feature that will reallocate in times of volatility from equities into bonds because they are safe. Well, that's not true at all, right? This is Finance 101. I know it's hard to explain, hard to like understand, I guess, but you know, the interest rate risk of crushing the value of bonds is real, and it's in history, right? Like that was, everybody wants to talk about Volcker and remembering all that. Well, do you remember all of that? Because this was set up to fail. We slammed interest rates down to zero in 2010. Well, guess when that came out? Duh, right? So when would we ever come out of it? In 2017, we tried to do some quantitative tightening. Didn't work, right? We gave up. In 2019 came around and we got bailed out by COVID, literally. So here we are. What are we going to do? Literally over the weekend, our fearless leaders have decided that they know how to solve this. The people that didn't see inflation coming, the people that said, well, you have to be safe by investing in our debt at low interest rates for liquidity purposes. They know what they're going to do. FDIC, okay, that doesn't exist anymore, right? I mean, effectively, we can still call it Federal Depositor Insurance Corporation, but I mean, why did that happen? Because the people at Silicon Valley Bank were Apple and Google and Amazon, and they had more than 250 grand in the bank because 250 is better than 100 for some reason, right? Bank runs, okay, well, we'll bail them out. You're going to make sure you have your money. And what are we going to do about this gap here to prevent more of these banks from being insolvent? This thing. I love the acronym, guys, but I'll explain that in a sec. This is the Bank Term Financing Program. I mean, they did think of that over the weekend, obviously, unless, yeah, terrible name, terrible acronym, because in our line of work, there's BTFD, and I'm in a church right now, so I gotta be careful. It's buy the freaking dip. Every time the market drops, you should buy it because it's cheaper stuff. This is buy the freaking pivot because it's coming. That's the solution, right? It's the Federal Reserve. What do they know? And you could say Treasury and Congress and whoever else is involved in this. What do they know? Print money, lower rates. Okay, guess what's coming? They're going to print money and they're going to lower rates. So what do you do about it? Well, we just said that when interest rates went up, the value of the bond tanked. Well, when interest rates come down, what happens to the value of the bond? You're seeing it today. Today was an amazing day. In fact, I think in the last 4 days, we've lost 20% yield on the 2-year Treasury. 20% in 4 days. And technically, I think it's only 3 trading days, 2 plus the open. That's huge, right? And it's interest rate risk. So we didn't participate in this because we know better, Matthews Wealth Management. We were way out of long-term bonds, and we've started dollar cost averaging. And if you know me personally, I have been screaming from the rooftops, just waiting for something to happen. Hey, it happened. Dollar cost averaging into long-term bonds was part of our plan from last year through this year, all the way through February. We just hit peak. You think the Fed's going to keep raising rates? Okay, well, that was going to be this week. that we were going to talk about. 50 basis points, 25 basis points. Okay, are we ever going to do it? Debt ceilings rolling around, and this is what they came up with. And so Biden this morning says, this isn't going to be funded with any taxpayer money. Okay, but it is going to be funded by inflation money, right? So it's not the people who are paying the taxes, but the people who buy things. That's a bigger group. So whatever you want to call it, man, it's going to be a cost. This stuff isn't free. Who gets bailed out? Well, unfortunately, not Silicon Valley Bank, right? But all these other banks that have the same situation. Sorry, it sucks to be first, but you did the exact same thing you were supposed to do. You were regulated, you followed the regulations, and now we're going to say, oh, we need more regulation. No, how about we get the idiots making regulation out of the way? These are not economists that are running things. These are politicians, these are media analysts and lobbyists, and it's the people who are making the profit on this whole thing. This should be the wake-up call, right? Like, so I've been through the Great Recession. I've been through the limited partnership issues that we had, the high-yield bond crash and COVID crash. Wake up. It's the same thing on repeat. It's the exact same situation. So these people solved it overnight. They didn't see it coming, but they're going to be on it, and there's going to be more regulation. Whatever. So sorry this was scattered and put together like in a day, but I think it's important to explain what happened, right? Because there's a lot of talk going on, and is my money safe? Yeah, your money's safe. It's just worth less than it was because of inflation. We turned on the printing press all over again. So congratulations. This is how we solve problems, is we kick the can into inflation. And then when it happens, we say, well, where did that come from? Well, it came from the stupid decisions we made when we didn't think about unintended consequences, right? So study up on classical economic theory, Austrian, Mises, Rothbard, just the simple stuff. Money's not hard once you take the crap out of it. This is a bunch of crap, right, that was engineered by people who make the profit on it, okay? It's not rocket science, but be ahead of the curve, pay attention to this, and look for the next opportunity, because there will be one. That's enough for today. So maybe I can get a market update video done sometime this week. It's been a couple of months. I apologize for that. It's done this until this week, where it did what I said it would do. It's actually a little bit earlier. So I guess I'm celebrating that. But we're properly positioned. I doubt you are. If you have questions, give us a call or stop me around town. I'll see you then.